Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have George Schultze, founder of Schultze Asset Management, to discuss what's happening in the corporate distress space. George, it's great to see you as always. Welcome back to Trade Talks.
Thank you, Jill. Great to be back.
And let's talk about the macro environment and what you're seeing in corporate distress generally, because it's been a huge reset with fixed income and a record-breaking year of losses.
Yeah, that's right. I mean, a number of indices are down 20% or more in fixed income, which is very unusual. In fact, I'm pretty sure it's unprecedented. Treasuries are down, investment-grade corporate bonds are down, junk-rated debt as well, bonds and loans, all types of fixed income has been impacted. And so it's a big reset, as you say, and certainly causing a lot of turmoil in the markets.
What does the Fed tightening strategy, how does it imply for future distress? What are you looking at as this tightening cycle continues?
Well, clearly, it looks to us here at Schultze Asset Management like the Fed is resolute in their effort to combat inflation. Powell said it at Jackson Hole about 2 weeks ago, and then he reaffirmed it last week at the Cato Institute interview that he conducted. And the net conclusion is that the Fed is looking to raise interest rates again, clearly, probably by 75 basis points next time they meet. And also, they will likely start reducing the Fed's balance sheet. So having said that, they are resolute in their effort to combat inflation, but you're starting from such a low. In fact, last year, interest rates were at the lowest level they'd ever been. And the Fed's balance sheet, on the other hand, grew to the highest amount it's ever been. So managing that change, where you're now seeing a lot of inflation come through because of the fixed income market, is going to be difficult. So we're expecting, very challenging conditions as the Fed tries to engineer a soft landing, as it were. And we're expecting more corporate distress. You're already starting to see some level of higher distress. We're seeing, certain pockets of companies impacted, but clearly higher interest rates and a tougher refinancing market, which go hand in hand with challenges in the fixed income market, will make for more distress. Also, inflation pressures, as well as supply chain pressures, are likely to continue impacting companies and their earnings. And so those companies that are over leveraged as well will likely face a higher risk of distress as well. And then, of course, because the fixed income market was so buoyant in the last few years, there's just been a record amount of leverage issued. And of course, with that, as distress or default rates start to climb with higher interest rates and tougher fixed income environment, you're just likely to see a bigger prevalence of distress across the whole fixed income market.
Right. And George, there's been some interesting cases of distress. Let's talk about the Revlon bankruptcy. You had mentioned leverage before, and the balance sheet issues with Revlon were certainly indicative of this.
Yeah, so Revlon, very interesting case. I mean, this is, as we call it, a good company with a bad balance sheet, which is often difficult to find. This company filed for bankruptcy in June of this year, really because of excessive leverage, but also due to supply chain issues. And Revlon, of course, has a storied history with Ron Perlman owning it and owning a piece of it, a significant majority of it, going back to the 1980s when it was originally a leveraged buyout. But along the way, it's been over-levered. Interestingly, a couple of years ago, in 2020, the company tried to do a refinancing with Citibank serving as its agent lender. And Citibank mistakenly repaid about $900 million of cash to its syndicated lenders. It intended to make a payment of $9 million and mistakenly paid out $900 million. Fortunately for Citigroup, it was able to claw back a significant amount of that cash, but it still, through last week, had about $500 million of that amount still outstanding. And it had lost the initial court ruling as to whether those lenders were allowed to keep that cash. This has never happened before. So finally last week, or actually it was on September 8th, the Second Circuit Federal Court of Appeals ruled that Citibank has the right to claw back that payment. So that, for Revlon, will make the case easier in that it'll make it more easy for the company to propose a reorganization plan, which is due by the middle of November. And they don't have to worry about whether Citigroup has a claim or whether these lenders who mistakenly received payment have a claim against Revlon.
And George, finally, let's talk about this Cineworld bankruptcy. Of course, a movie theater operator that filed for bankruptcy on September 7th. This is really super interesting because it didn't get any of that benefit from the meme stock rally that actually helped AMC avoid Chapter 11.
That's right. And that typically doesn't happen. You can't really rely on the benefit of a meme stock rally to save your company if it's over levered and facing risk of distress. In fact, that's what most people thought would happen with AMC before its stock surprisingly rallied and allowed that company to raise hundreds of millions of dollars in cash. So Cineworld is sort of proceeding along a more typical path. On September 7th, just last week, it filed for bankruptcy. This company, very similar to AMC, it's the second largest theater operator. It owns the Regal cinema chain in the US. And of course, it had to file for bankruptcy due to excessive leverage. In the case of Cineworld, we're talking about net debt, not including lease liabilities, of almost $5 billion in total. So we'll see how that all shakes out. But I think you'll see more situations like that, more companies filing for bankruptcy, unable to benefit from these unusual meme stock type rallies and things like that. And sometimes complexity, like you see with Revlon, with litigation between lenders. So I guess to summarize it, we're expecting a lot more distress going forward, and it's certainly going to be an active time with interesting cases to boot.
All right, George, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.